You find the perfect setup and set a safety net. Your stop loss, exactly where the books say it should go. Then the price tips down, hits your stop loss, and immediately spikes right back up in the direction you predicted. It can feel like the market is watching your every move, but this is actually a mechanical part of how the largest financial institutions operate. Prices rarely move in straight, predictable lines. Instead, they breathe and pull back in a rhythm that works very much like the ocean tide. Learning to recognize this ocean behavior allows you to stop fighting the movement and start moving with the trend. In this world, big institutional investors are massive ocean waves. Small retail traders are like kids on the beach building sandcastles. When many small traders place their stop-loss orders in the same obvious spots, they create what professional traders call liquidity. These are basically dense clusters of pending orders. Large institutions need a huge volume of orders to fill their own massive trades. To get that volume, the big waves often crash into these clusters of sandcastles to gather the water they need to fuel their next big move. This means the very spot you chose for your safety net is often the exact fuel the largest players are looking for. To map these hidden sandcastles, look at the entire beach. The highest high tide and lowest low tide marks are external liquidity, the market's major boundaries. In between, the sloshing water leaves smaller sandcastles and isolated puddles. This is internal liquidity. External liquidity represents the long-term destination of the market, while internal liquidity is mostly short-term movement. Identifying whether the market is currently targeting the middle puddles or the distant horizon is the key to predicting what the chart will do next. There are two specific ways the market water behaves when it reaches these clusters of orders. The first is a liquidity sweep. This is a temporary move where the price briefly dips to hit a cluster of internal orders. The wave pulls back to consume a small internal sandcastle, using the energy from triggered stop losses to surge forward in its original direction. Then a liquidity run occurs, a boundary-breaking surge crashing completely past the high tide line at the top of the beach. A sweep is a brief collection of fuel, while a run is the main force moving the market into a completely new price range. When traders mistake a brief sweep for a permanent change in direction, they often exit their trades at the exact moment the market is preparing to move back in their favor. How can you tell if a sudden dip is just a temporary sweep or a sign that the market is actually reversing? The answer is to zoom out and find the direction of the main tide, or the primary trend. If the main tide is rising, the largest waves are ultimately aiming for the high tide mark at the top of the beach. Because the primary trend determines the final destination, these small backward moves are the moments where the market is actually gathering the orders it needs to keep climbing. Watch for this specific setup, a rising trend that takes a sharp drop into a cluster of previous minor lows. While this drop looks like a reversal, remember the bigger picture. Since the main tide is rising, this dip into internal territory is likely a sweep. The price bounces off those lows, having gathered the necessary orders for the next push. Once that internal fuel is collected, the market is ready to execute a run toward the high tide mark at the top of the chart. When you identify internal sandcastles and trust the main tide's direction, you can stop being the fuel for others and start